I'm Leah Del Percio. For those of you who don't know, I'm the founder and CEO of True State, which is basically a service that closes estates at the click of a button using care, compassion, and technology. Today, here with me, I have Brian Simmons, who's a co-founder and chief trust officer of Icon Trust, which is a Nevada chartered, non-custodial, non-investment trust administration company. He's also up at 7 a.m. right now, so let's give him a big round of applause. And then I also have Conrad Dietrich here with me. He's a trust and estates and tax exempt organizations attorney at DLA Piper in Baltimore, with over 10 years of experience helping families and individuals create tax efficient plans to manage family wealth and small business holdings. He's also involved in Baltimore's theater scene. So with that, I'm just going to get started and ask you both kind of a series of questions that, for me, when I was on my entrepreneurial journey, were things that I thought about, but kind of knew some of the answers to as a trust and estates lawyer. And I felt that other entrepreneurs could really benefit from knowing, if they obviously aren't trust and estates lawyers most of the time. So I'm going to start with you, Conrad. And just ask you a couple questions that I think would be really beneficial to our audience. So, one question I have is, why does estate planning even matter for young entrepreneurs? Especially considering the fact that, they often don't have a lot of cash and, they're thinking about their own business.
That's a great question. And there's two parts to the answer. One is that the hope when you are an entrepreneur is that your project, that your business is going to be successful, that you're going to make a lot of money. And the other part of it is that, so maybe I'm going to have three pieces, but the first two are that one, you hope you're going to make a lot of money. And two, the estate tax, especially in Baltimore, is like a combined 50% federal and state estate tax. That is a huge hit. And that's a brief way of saying that estate planning is important for entrepreneurs who are thinking long-term. And that is maybe sometimes a hard switch. A lot of people who are entrepreneurs don't come from family backgrounds that have a lot of wealth already. And so they're not necessarily already used to thinking in those terms. But when you're thinking about wealth and thinking about wealth multi-generationally, there are tax considerations. Again, that federal and state estate tax is 50% combined. That is the hit that you take. But also thinking about how to care for your company and how to, or if your company monetizes the proceeds from your company, multi-generationally.
That makes a lot of sense. And that's really good to know. When do you think is like a good time for estate planning techniques when you're building a startup?
Honestly, the earlier the better, and here's why.
I see Brian shaking his head. So
I agree. I agree with Conrad on that. We see too many people wait too long, and to Conrad's point, it is easier to plan for wealth that you don't have now, but you're going to have in the future, than to try to plan in the future when you have a lot of wealth. So yeah, that's why.
Right. At that point, you're playing catch up, and there's a lot of things that we can do, but it is so much easier to put good structures in place now while your business is small, and I mean this in the best way possible, not worth very much, because its value is future potential. And that's not yet realized. And so being able to do planning with your company while it's small and while that value, that fair market value on it is still small and it's mostly potential. We all want to see wild growth and potential, right? We all want to see these projects just blow up and become incredible success stories. It is a lot harder to do good planning after you're already wildly successful, and a lot easier to do it before. And the reason why, if I can just take a minute to get in the weeds just a teeny bit conceptually, this is tax stuff that we're talking about. This is the way that wealth taxation works in the United States, which is that we have this estate tax that taxes everything that you die with at again, state and federal. If you're in Maryland, we're in Baltimore, it's 50%. But they get it from you either way, whether you die holding it or give it away during your life. It's this combined, it's this unified tax system. But you have this exemption, like the tax system allows you to give away a certain amount. And when I say give away, I mean by gifts during life or as part of your estate at death, to give away a certain amount tax-free. Right now, the amount is really high. Historically, it's been in the 1 to 3 million range. Right now, it's 11 million. This is probably not going to stay that way, but it is a lot easier to do planning with a $500,000 company than with a $50 million company, because you can move it out of your estate. And when I say move it out of your estate, I mean what the government is going to tax. You could take it outside of the tax system without paying any tax right now while you're still small. Once you get big and successful, and whether it's because your company is just successful or whether because you've sold it and cashed that humongous check, now you're sitting on a large pot of wealth that you can't move out of your estate for free.
Yeah, that makes a lot of sense. And I think it's more of, and one thing that I know from practicing trust and estates law, we often think as entrepreneurs, the more valuable our company, the better. But once you're starting to do planning, it's almost like the less valuable your company, the better, because the smaller you are value-wise, the more nimble you are, and the better ability you have to move things around in a way that's tax advantage to you. I had a conversation last week with, someone who was, dealing with entrepreneurs who were getting ready to go public, and a lot of them were moving to other countries to avoid the tax realization event that they would have, which again is a lot of the money that you worked really hard for. So really, really interesting perspective, and I think it's good for people to hear. One quick question. So oftentimes, people have heard of this thing called a GRAT. So I'm curious, like, what is a GRAT? And I obviously know this, but not everyone in the audience does. And why do we hear so much about them from, minimizing the tax load kind of perspective and a way to really encapsulate the value of your company without taxes? Like why do we hear about them, and what are they?
Well, we hear about GRATs a lot because GRATs are easy. They're an easy sort of off-the-shelf planning technique that's easy to wrap your head around, and they have explicit support in the regulations. So it's a tried and true method. I don't think a GRAT is a good vehicle for entrepreneurs, but I'd like to take just a minute to explain what a GRAT is and why I don't think it is I think there's better options, and I think that can you do a GRAT? Yes. Have I done a GRAT for entrepreneurs? Yes. Do I think it's the best option? No. And I'd like to just take a quick minute to talk about what a GRAT is and why I don't think it's a best match for an entrepreneur, and why I think that there's better options. So really briefly, a GRAT stands for Grantor Retained Annuity Trust. And in a classic GRAT, you take an asset and put it in this trust that pays you back an annuity amount for 2 to 9 years, let's say. And this is some complicated calculations to decide how big that annuity has to be. But in essence, what happens is over time, it's going to pay you back something like a little more than 100% of the value of what you put in. There's a threshold appreciation rate that basically, if the assets you put in the GRAT appreciate over that amount, the excess appreciation is not coming back to you, and it passes out tax-free to your beneficiaries, whether that's in trust or whether that's just to your kids or whether that's to, I don't know, your grandma, which is not good estate planning, but maybe grandma needs it. That's reverse estate planning. We don't love that. But a GRAT, so the mechanics of a GRAT is, in a classic GRAT, I take a single stock position. I take something like, the most successful GRAT I ever did was a GRAT that we put together in 2008 using Wells Fargo stock at the absolute bottom of the, or it was 08 or 09, absolute bottom of the financial crisis. That stock wasn't worth anything. And we put a single stock position in this GRAT and calculated the percentage payout. It's a certain percentage every year, and a percentage of the initial amount you put in. So there's a dollar amount that comes out every year based on the value on the day you put the asset in. So it was like a 5-year GRAT for this Wells Fargo stock. And by 2013, the market had largely corrected, and that stock had doubled or tripled in price. It was a wild success. So it paid out this annuity in kind, actually, kicked out some Wells Fargo stock back to the client. And then at the end, there was a huge amount of value in this GRAT that was able to move to beneficiaries tax-free. It's great and easy with GRATs. There's not the good things about a GRAT is there's not a lot of downside. There's the cost of setting it up and administering it. But the worst that happens is the risk is you die before it's all done and it just doesn't work. But you're no worse off than you would have been before. And for people who are young and at the beginning stages of wealth, that's not even a big risk. And you do shorter term GRATs, and it's not a big concern. But that's I mean the risk is you get hit by a bus. But even then, there's not a downside. It just didn't work. You're no worse off than if you hadn't done the GRAT in the first place. So the issues there are, it works great it's great with a single, it's very best with a single position of a publicly traded stock. And the reason that I say that is because the value is very easy to ascertain, because you have to know the value every year. So you're going to make this annuity payment every year. And that is really easy if it's Wells Fargo stock and you literally just look on Yahoo Finance to see what the value is on that day and pay that annuity in kind back out. It's also great to do with single stock positions because because it's kind of an all or nothing thing, you can capture a really big upswing. And if it's not successful, it's just as well. The best GRAT programs I've ever seen have been multiple GRATs with single stock positions over time, and then some of those have been really successful. The reason I don't think it's great for an entrepreneur is the issues with time horizon for valuing your company, all eggs in one basket, and difficulty of valuing your company on an annual basis. God bless all of you. I just know you're not going to do it. and I know you're not going to get it valued every year. You're not going to do it. And so if I set this up for you, it's a pain in the butt, and you're going to resent me every year hounding you to get this valuation. It's not.
Yeah, and most of the time at such an early stage, we're using convertible note structures and safe agreements to even form investments because we don't want to place a value in our company, because then we're upheld to a benchmark that we have to meet. So, until you're doing equity financing, you're not getting a value every year.
Correct.
So maybe when you're like Series A, but if you're going to do a B round the following year, but that's such a unique sort of to be in. So, really, really interesting administrative point for why we shouldn't use them.
Look, if you have a really strong sense of what your monetization time horizon is, a really strong sense, and you are in a position where you're able to get annual valuations and you're willing to do it, a GRAT could be a good vehicle. But even then, I still think that a sale, what we call a sale to a Grantor Trust or a sale to an intentionally defective Grantor Trust, does the same thing and does it whether you know the time horizon and you only have to get it valued once, and that's a better vehicle than a GRAT. GRATs are for people who are trying to freeze their estate, who have a portfolio of marketable securities, and they're trying to lock in what they've got and not get richer. GRATs are what we do if you come to us after you already got rich and you didn't do your early estate planning, and we need to figure out how to triage the fact that you have a very good problem, which is that you're absurdly rich now, but the downside is that you're going to pay a lot of it to Uncle Sam. So a GRAT is a great triage project if you didn't come to me early. You're on mute, Leah.
Sorry, that makes a lot of sense. So if grants don't make sense, what would be a good strategy for, an earlier stage entrepreneur to use when it comes to their stock and their interest in their company?
So like I said a minute ago, I think that I mean, it's not one size all, right? It always kind of depends on, this stuff's always individual, and there isn't an off-the-shelf answer, but there's kind of a suite of what are usually the best answers. So there isn't an off-the-shelf answer, but there also is. It depends on all the factors, and everyone's situation winds up being individual, and people will come in and be like, my situation is very simple, and this is as a lie.
Yeah.
But because they don't know whether the situation is simple or not, and their idea of very simple may turn out to not be my paralegal's idea of very simple. But what I mentioned before, a sale to what we call an intentionally defective grantor trust, a sale to this kind of irrevocable trust, does a lot of the things that a GRAT does, but in a way that doesn't have a GRAT's same risks and same downsides. And what it does is it takes advantage of a disjunction between the income tax and the estate tax. And that is that you can create a trust that is irrevocable, meaning it's like a permanent entity, right? That is outside of your taxable estate. So it's out of your wealth tax system. But that's for estate tax purposes. But for income tax purposes, it still counts as you. That's called a grantor trust. This whole section of the tax code that's about this, and there's all kinds of rules for it, but it's very easy to create this trust that is it's like a disregarded entity for tax purposes, for income tax purposes, but it is outside of your estate completely for estate tax purposes. So you can sell your company to this intentionally defective grantor trust, or we call it an IDGT. You can sell it to this trust, and that is not an income realization event. That does not count as a sale for income tax purposes. The IRS does not care about that sale, doesn't want to hear about it. I don't even report them.
It on your tax return that year.
What's that?
Meaning that you don't have to report it on your tax return that year.
I don't report it on anything.
Okay, so you're not putting that on your annual 1040 on
Nope.
What normally is April 15th.
Nope.
Okay.
It is not a sale for income tax purposes. So what you've done is you're able to take your company and this is something we would want you to do early, right? To the extent that's possible, we want you to do this early when your value is low. Again, it was a little counterintuitive, but for planning, we want everything valued as low as possible always, because we want you to pay as little tax on it as possible. There's a little bit of attention because sometimes you want things to be valued high for other reasons, and we can only play so many reindeer games before the IRS starts to get really upset about that. But you take this asset by this asset I mean your company that has a really low startup value, and you sell it to this trust for a promissory note. So this the trust owes you a note, and so in your estate tax situation, you have frozen the value of that asset at its early startup.
Yeah, and to clarify, I think for the non-estate lawyers, a note means a loan. So it's like you lend money.
I mean, people own houses. It's a loan, right? So the trust is going to pay you over time for what it bought from you, and it can even wait a little while. Just maybe manage the interest, and sometimes you cycle money through to make that happen. The trust is going to pay you over a long period of time for the company, and the idea is that you've sold the company, and so now instead of owning the company, you own this receivable from a trust that is locked in at one price, and the company is now out of your estate, and it is going to steadily increase in value or monetize or be sold and realize a hopefully an immense amount of money, all outside of the wealth tax system, the wealth transfer tax system. And that's a huge win. And the time horizon doesn't matter. It's not like a GRAT where you need a certain amount of years, and you only have to get it valued the one time just to do the initial sale. it's a really great technique, and it has worked. It has been wildly successful. I mean, I can't name names, but I've done this with auto dealerships. I've done this with I did this for an entire suite of executives for a software company in Maryland that then turned around and was sold for an immense amount of money. Just made them all wildly rich, but wildly rich in these trusts. So it's not in their estate tax system. They're not going to get, when one of them dies, they're not going to pay 50% to Uncle Sam. It's all outside the tax system. And these trusts are built to benefit them.
They don't have to move to Puerto Rico or
Guernsey or wherever.
Jersey, Isle of Man.
Yeah.
Random,
Grand Cayman. None of that. None of that. And even then, look, they'll get you. There's an exit tax. They'll get you going out.
They'll get you coming and going.
Exactly. Yeah. So that's really good to hear. And so basically you were able to do this structure. Like, what stage did you do that structure in of this company? Were they in between like a Series A and a Series B, or were you able to do it at pre-seed? Like, like how early on did you start the process with these startup executives to get them that savings?
So the two that I'm talking about, the two that I'm talking about actually weren't startups. These were well-established companies that just turned around and were sold. So these were companies that have been going for years. Just the software company wasn't actually a startup. It's a software company that's been in business for a long time. They just sold to a bigger name and sold for a premium price. And the difference between the appraised value and what the tech giant paid for them was large. With a startup, there's even more potential for success because your startup's just not worth anything at the beginning, and that's great. We love that it's not worth anything at the beginning because the upside is so big that from a return on investment standpoint. Now, this technique, there is complexity involved. Like, now you have a trust and you got to deal with this trust. It's not the end of the world. If it's successful, you've become very rich and you pay lawyers and accountants to deal with this. That is part of the sometimes that's the thing for entrepreneurs to wrap their head around, because they're used to sort of like doing everything themselves and knowing everything. And part of becoming very successful in this means that you now have to have a team that knows the things that you don't, and rely on them. And it's, I mean, that's part of the price of being very, very rich.
That's where we come in.
Yeah, exactly. Well, I'm used to being, the accounting office for my company and doing all the finances, and really you wear a lot of hats early on. So I look forward to the day where I can have a team to do it for them.
Yeah, right.
Anyway, so that was really, really helpful, and especially the sales to idiots section. I think that it'll really benefit people to know that this is available, and it can save them tens of hundreds of millions of dollars down the road, depending on what their valuation is. So Brian, I think this is an interesting, area to sort of loop you in. So sure. Conrad touched upon, sales to idiots. Can you explain, where you come in? And as I said before, Brian is the chief trust officer and co-founder of a Nevada trust company. So often we hear about Delaware, and you'll often structure your startup to actually be a Delaware C Corp or a Delaware LLC. And we sing the praises of Delaware, but oftentimes states like Nevada are even better. But I think for people who are non-lawyers, it would be interesting for them to really understand why. So can you explain kind of what you do and
Sure.
Where you could come in handy to people like myself and those of us on the call?
Yeah, can you see my screen? I like I said, but on the pre-call, we have some cheesy slides here, but hopefully will be memorable. So we're, as Leah said in the introduction, we are a Nevada chartered trust company. We are non-investment, non-custodial. And so kind of a lot of what we do, or most of what we do, is we deal with out-of-state clients that are coming to Nevada to take advantage of Nevada law, typically for asset protection at its core, and then income tax planning. And we'll go through some income tax benefits here as well. And then what Conrad called an idiot, and kind of his sale, we call a beat it. And I'll give you some more color on that. I think we're talking about the same thing. But I like to steal terms from anywhere I can. And so I'm a musician, and I call a lot of what we do theme and variations. So everything that we do, or almost all of what we do at its core, is an asset protection trust. There are asset protection features. Nevada has very strong and powerful asset protection, creditor protection statutes and laws on our books. We are a very creditor unfriendly state. We're a very beneficiary, very grantor friendly state. And so a lot of what we do is asset protected at its core, and then attorneys will toggle different things on and off, whether you want to do income tax planning, or whether you want to do estate tax planning, or whether you just purely want to do asset protection planning. So, kind of the bare basic of what we do sometimes is just an asset protection trust. We've got an entrepreneur, their business is their primary asset. They live somewhere else, but they want to take advantage of Nevada's asset protection laws. They want to set up a trust for their own benefit, where they're a beneficiary, make it a rainy day fund, make it where their creditor can't reach in and grab their business. You take it up a notch. If the entrepreneur, and I think I told Leah, I mean, it really depends on where in the life cycle entrepreneur is. So many times when people hear the word entrepreneur, they think of somebody that's young, just starting a business. But we deal with entrepreneurs that are in their 60s and that have started and sold multiple businesses through their career. But if you have an entrepreneur that's married, they can set up a trust for the benefit of their spouse and do a hybrid asset protection trust, and put assets in the trust for the benefit of their spouse, have access to the assets. Why Nevada is a great place is we have a very, very short waiting period. We have no exception creditors. So we're, like I said, a very creditor unfriendly jurisdiction. We do a lot of income tax planning. So Nevada does not have a state income tax. So we have a lot of entrepreneurs that have made a business, they've developed a business, they've gotten it to where it's has significant value, and they may not have done any planning yet. And they're contemplating a capital event. They're contemplating a sale. And they are staring down the barrel of a really, really large state income tax. And Conrad already talked about that in Baltimore. We do these all the time. They're called NINGs. So NING, you got to love attorneys and acronyms, and the alphabet soup is the way that I call it. So a Nevada Incomplete Gift Non-Grantor Trust. So you have a Nevada trust. Client sets up the Nevada trust. It's an irrevocable trust. They transfer their business. You're not doing it for estate tax planning, so they can just transfer it. And usually it's done with a business with low basis. And they're anticipating a really large sale. The example I gave Leah, and she wanted me to talk about it, and it really goes to the saying, the pen is mightier than the sword. We did a NING for a resident in the Northeast, and he had literally started a business in his parents' basement. I can't make this up. And on a Wednesday night, sitting in my pajamas on my bed, I signed electronically the sale documents for the business. It was $1 billion sale that he avoided state income tax on. I was driving into the office the next morning listening to CNBC, which is what I do, and it caused a $42 billion swing in the stock market. The company that bought it went up, 3 other companies went down, and we saved him literally hundreds of millions of dollars in state income tax. So it was a really fun deal, and it was kind of funny. I was joking with Leah, and I said, they were talking about it like it was breaking news on CNBC at 9:30 in the morning, and I was like, no, I was breaking news at 8:30 last night, when I was sitting there in my bed signing it in my pajamas. So you can transfer a business to a Nevada trust, and then we as the Nevada trustee sell the business. So those are really, really fun deals. I'm not a big tax fan, whether it's income tax or federal estate tax. So anytime you can legitimately avoid, and I always say there's a difference between avoidance and evasion. Evasion's a crime. Avoidance is just good planning. Anytime you can avoid tax, I think is a good thing. So this, I think, is what. Go ahead, Leah.
Yeah, so I wanted to ask you just a quick level set, how do people use a Nevada trust company? Like if I'm sitting in Maryland and I'm an entrepreneur, how do I create a Nevada trust? And that's where you come in to basically, be located in the state of Nevada. I think that's interesting so people know. And then it's also like, are you, involved in my business on a day-to-day level? If you could explain some of that, I think that would be really helpful too.
Sure. So, I mean, we get on calls with clients, potential clients, their advisors, their advisory team all the time, and we can be a good resource and kind of point clients in the right direction. If they give us a fact pattern, here's what I have, here's what I'm trying to accomplish. Is it income tax? Is it estate tax? Is it asset protection? Is it a combination? We work with attorneys all across the country, and so we've got attorneys all over the place that we work with that do a lot of Nevada planning. And so in many cases, we can bring somebody to the team if needed. If a client already has an existing attorney that they work with that may or may not, might not be as comfortable with Nevada planning, we've got attorneys here locally that we can bring to the table that do a lot of co-counseling work. They're very non-threatening. A large portion of their business is to work with an out-of-state attorney that a client already has an existing relationship with to bring kind of the Nevada planning to the table. As a matter of fact, my wife happens to be a Nevada estate planning attorney, so her and her firm, they do a lot of that. There's 5 or 6 firms here just locally in Vegas that I can think of off the top of my head that do that. So we can bring somebody to the team. As far as being,
can I interrupt real quick and say something a little bit sassy?
Sure.
I think that, and again, this is a little bit sassy, and maybe people will disagree with me, but I think that if you are an entrepreneur and you feel like there's upside to what you're doing, and you have an estate planning attorney who balks at out of state or other states law, you need to find a different estate planning attorney. It's just.
I tend to agree. So what Conrad just brought up is something we call forum shopping. So there's a misperception from the end client level in a lot of cases, and even some attorneys, as Conrad just alluded to, that to do Nevada planning or to do Delaware planning or South Dakota planning or Alaska planning, I mean, quite frankly, we compete mainly, just to be honest with you, we compete mainly with Delaware just because of the East Coast mentality and their very strong, longstanding corporate law. I would argue that Nevada law is probably a little better. But at the end of the day, if I lose a case to Delaware or South Dakota or Alaska, and it's a Florida client, I'd rather them do good planning in a good jurisdiction than have an attorney in Florida say, no, you can't use a Delaware trust, or you can't use a Nevada trust, or you can't use a South Dakota trust. So I agree with Conrad. We call it forum shopping. And the misperception is that if you're a Florida resident, you cannot have a Nevada trust. That's simply not true. Trusts are at their core, if you boil them down and distill them to their basic function, they're contracts. And we are in the United States, and contracts go across state borders all the time. And so a Florida client can have a Nevada trust, a Florida client can have a Delaware trust or a South Dakota trust. So I agree with Conrad. Conrad, it's a great point. Forum shopping is a really big deal. And quite frankly, that's how most of our clients get to us, is they are somewhere else and their attorney says, hey, Nevada's great, Icon Trust is great, go use them. And that's how we get to it. But to Leah's point, one benefit of Nevada, and this is typical of most top tier, what I would call top tier trust jurisdictions, is we have a very powerful directed trust statute. So I use a really cheesy three-hat analogy. If you look at like the core functions of what a trustee does, there's the administrative function, which is to keep books and records and sign tax returns. There's the distribution function, which is choosing when a dollar is going to come out of the trust and go back to a beneficiary. And then there's the investment function, choosing what a trust is going to buy, sell, and hold. Most people think that all of those are one. And in the 250-year-old trust model, kind of what I call the Northern Trust model or the big bank trust company model, that's the case. They want assets under administration so they can manage money. And they wear all three hats. Almost
fees for all three things.
Yeah, they all three. We are very comfortable serving as the administrative and the distribution trustee. We don't manage money. We don't pretend to manage money. We can't manage money. We don't want to manage money. And so many of the trusts that we get are directed trusts where you bifurcate the role of trustee. We're the admin and distribution trustee, and the client or a family member or a friend or somebody else retains the investment discretion, and they get to tell us what to do. So to Leah's question about how much are we going to be in the client's business, we hope zero. I mean, that's our model. That's the way we want to work. We don't want to be in their business. They know the widget business better than we do. Why should we come in and tell them how to run their business? So that's a very, very different model. It's been successful for us. The clients we work with are coming to us because they like that model, and it's easy. I mean, it's easy for us. It's easy for the client. They can kind of continue business as usual. They can continue to take a salary from the business if it's an operating company. They can make payroll. They can put a new roof on the building. They can buy a new piece of equipment. They can do all of that, and they don't have to come talk to us. So it's a very kind of non-invasive way for clients to run.
From the estate planning attorney side, I just want to say that I have so much terrible experience with the 250-year-old big bank trust company trustee model. I will go to the mat to convince my clients not to do that. But I have a lot of really, not with Icon Trust in specific, but a lot of really great experience with trust companies like Icon Trust in trust-friendly jurisdictions. Like that's a model that works and is good and won't be an albatross around the client's neck.
Yeah, I appreciate that. Yeah, that's kind of our model. I mean, we try to keep it simple for the client. I mean, by the time clients get to us, really, they already have a team in place. Kind of the way I put it is a client starts a business, they become successful. At some point, they probably hire an accountant that helps them with their personal and business tax needs. At some point, they're successful enough that they have discretionary income to the point that they start investing it, whether it's in other businesses or back in the business that they already have, or they open up a brokerage account with their favorite advisor. And then somewhere along the way, somebody says, hey, you need this estate planning stuff. And whether that estate planning stuff is asset protection or it's dynastic planning, to push money, kind of they have so much net worth that they can push money now down to the next generation and use the exemption that you were talking about and just gift money to their kids or grandkids. Or they want to do a spousal lifetime access trust where they gift money to their spouse and use up their exemption because it might go away, but they still have access to the funds through their spouse, or just pure asset protection. But you need this estate planning stuff. By the time clients get to us as a trust company, we're the last member of the team brought in, quite frankly. I mean, we come in at the 11:30 hour. And so we always say we play well in the sandbox because we don't do anything that anybody else does. And most of the time, they don't do anything that we do. So we do the administration. Client has a CPA, they have an attorney, they have an accountant that they work with. Somebody said Nevada is good, so we're going to forum shop and we're going to go to Nevada. By the way, we know Icon, we know Brian and his team. Let's use them. Yeah, it's a model that works. So I agree with you, Conrad. The big bank model, I think, doesn't make sense in the entrepreneurial world, doesn't make sense in the business owner world in a lot of cases.
Doesn't make sense in any world.
You said it. So I got this beaded up here. I got to talk about Michael Jackson. This is the idjit that Conrad was talking about. This is what we do a lot with entrepreneurs, especially younger ones. This is the one that's easier. It's easier to plan for assets you don't have or money you don't have. I'll take the bottom example first, opportunity shifting. If you're going to start a new business, and kind of the way we do it, Conrad, and I'm not sure if this is specifically what you were referring to, we typically have a figurehead grantor. So like mom and dad set up trust for the benefit of the beneficiary. They do a $5,000 gift, and now becomes defective, which just means who's going to pay the tax. It's gotta love attorneys and coming up with easy to sell terms like a defective trust. So it becomes defective to the beneficiary. The beneficiary, who's the true client, becomes the taxpayer. They can transact, as Conrad said, on a tax neutral basis. They can sell their business for a note back, promissory note back, or a loan, essentially. It's outside their estate. Kind of my really, really cheesy example on this is Bill Gates, for example. So Bill Gates, when he started Microsoft, everybody knows he started it in his parents' garage. And he started it with a loan from his father. And the really, really bizarre part about it is, and I know it's a bad example with everything going on with him in the news now, but his father actually was an estate planning attorney. And I don't know that many people know that. And so instead of giving Bill Gates the money or loaning him the money for Bill Gates to start Microsoft on his own, if Bill Gates had set up, Bill Gates Sr. had set up a trust for Bill Gates Jr. and he had started Microsoft in that trust instead, in a beat it like this, his entire multi-$100 billion fortune would be completely out of the estate tax system. And he would owe zero estate tax on anything. And so it's kind of a really, really kind of cheesy but extreme and real example of opportunity shifting. You start something that's worth nothing now, that's going to be worth billions of dollars in the future, and it'll be completely outside the estate tax system. We do this with smaller businesses. We've got a really cool family in Northern Ohio that did this. It's 4 siblings, machine business. They sold a business that was worth probably 25 million at the time collectively between them. That's now worth about 150. So collectively between them, that $125 million spread that the business has grown to is outside their collective estate tax. So it's a really, really powerful strategy with entrepreneurs and startups and younger companies. So those are kind of fun. Not sure what else we have.
Oh, yeah. Can you explain some of the benefits of going to Nevada? So, obviously, I personally love Nevada for all the asset protection benefits, but I think it would be good to get into some of the specifics.
Yeah, we've already touched on a lot of this. I mean, we have no state income tax, so we can do a lot of income tax planning, even on like a mom and dad's revocable trust. So if mom and dad have a revocable trust, it's got a sizable net worth in it, and they don't want Junior to get all of the money outright because they have some issues. You can have a trust in Nevada where we don't pay state income tax on the income, and we pay a little bit higher on the trust income tax side. But if you're not going to distribute income out to the beneficiary, there's no reason to have it in a state where the state's going to tax the income in addition to the trust. So no state income tax. That's very powerful. In the NIG example I gave you on the client that saved, a couple $100 million in state income tax.
Yeah.
We do a lot of Go ahead.
Oh no, I just said yeah.
We do a lot of dynastic trust planning. So if you look at Nevada, our rule against perpetuities, which is the period, the length that a trust can last before you're required to take distributions out and pay tax on them, the estate tax on them. We're 365 years. We're 365 because Florida was 360, and we wanted to be better than Florida. There are some states like South Dakota and Delaware that are essentially perpetual. We think 365 years is long enough, but it's better than like life and being plus 21 years. We have very powerful asset protection statutes. I think we're the top asset protection jurisdiction in the country. We have no exception creditors. So a divorcing spouse for child support and alimony, for example, in Delaware, a Delaware trust, they can pierce. Delaware statute is 4 years versus our 2. And Delaware has pre-existing tort creditors, which means even if there was a creditor that you didn't know about, couldn't know about, had no way of knowing about, the example I give is the OBGYN that delivered 250, 5,000 babies during his or her career, retires, has one of these trusts set up in Delaware, and somebody pops up and says, hey, you delivered me 25 years ago, and I have some issues, and I think it's because of you. That's a pre-existing tort creditor that could potentially pierce a trust in other jurisdictions. We don't have those in Nevada. Our directed trust statute's really, really powerful, makes us comfortable as a trustee. We already touched on that we don't want to manage money. We want the clients to be able to tell us what to do. The last one, this is kind of interesting. We could do a whole presentation just on this, our decanting statute. So there's a perception that if you have an already existing irrevocable trust, that you can't do anything with it. You can't change it. You can't modify it. You can't fix things. That's not the case anymore. So if you, depending on the trust and the terms, you can possibly decant the trust. And we did steal from, the term did come from the wine industry. You basically have the old bottle, you have the new bottle, which is the new trust with all of the fixes and bells and whistles you want, and you decant or pour the assets from the old to the new. And so there are things that you can modify and change through decanting. So
really, really cool.
Yeah.
Well, this has been really educational. I'd love to open it up. I'm sure, our audience members have some questions. I know I have one here from Tika. Besides selling to and this is for both Conrad and Brian, besides selling to an irrevocable trust, what are 1 or 2 moves a promising entrepreneur can make right now?
I'm happy to field that one first. Selling to a grantor trust is a great freeze technique, a great planning technique to keep wealth out of the tax system and out of your estate. But that's like an advanced planning technique. I would say before you even do something like that, step number 1, you need a solid estate plan for yourself in place. No matter what, that's your absolute step 1 before you start doing sales to grantor trusts, or before you start doing a ning or a ding, but probably a ning. Ding is the Delaware version, and I mean, everything that Brian said about Delaware is true. Delaware is a cutting edge jurisdiction. They invent a lot of these laws, they pioneer a lot of things, and then other states come along and do it better. That's it. So Delaware does it first, but not best. So Nevada is a great example of a state that sees Delaware's mistakes and does a better job, and that's great. But you need a solid basic estate plan in place, and you need one that's good and that's durable, and one that's robust. The other thing that I would say is thinking about business succession planning early is really critical. Making sure that you have really good even just the incredibly basic stuff, making sure you have a really good operating agreement or really good shareholder agreement, that you have those kinds of business documents in place, not something that you got off of Rocket Lawyer, but like, look, I know what we're all doing here. I'm just being completely honest. I know what all of you did. So now it's time to stop and go talk to a lawyer at a shop that can put that kind of thing together, not just for now, but also thinking long term, because you're not going to be like, you are building something to last. And whether it's a company that's going to last or whether it's a company that's going to sell and make you rich to last, you're building something to last. And so taking the long view is we specialize in taking the long view, and we can help you take the long view. And so thinking about business succession planning, who is going to own it next after you, who's going to run it next after you, what happens if you get hit by a bus? All those things are it's an essential package to start out with. So rather than suggesting another kind of exotic estate planning technique, I would say your first steps are your own plan and your business's plan.
Yeah, I agree with Conrad. I mean, honestly, we see so many business owners that have done nothing, and I'll go even simpler. I mean, I think what Conrad is referring to is a revocable trust to make sure that anything. I mean, you can get into all this exotic stuff, which is great and it's good planning, but take care of the basics. Revocable trust, title everything you can in the revocable trust to make the efficient transfer, to keep control over it. Make sure you have a will. I cannot tell you how many clients I talk to, and I know we're probably going really basic and Leah's going to roll her eyes at us here in a second, but I cannot tell you how many clients we talk to that have minor children and don't have a will. And so there's not even anything in place to take care of their children if something happens to them. And it goes back to the early entrepreneur. They think they're young and invincible and it's never going to happen to them. I've been doing it long enough. Conrad's been doing it long enough. We've seen like bad horror cases.
Yep.
Make sure you're taking care of your family. Make sure you're taking care of your loved ones. Do the basic stuff first. We can add this fancy stuff later. But yeah, that's a good point. That's actually what I was thinking when that question came up. I was thinking the same thing you were. So
I would also add to that one of the most important things that you can do as a young entrepreneur is to have a mind shift in how you think about this stuff. I know it's tempting. You're all brilliant. You're smart. You are probably towards like you probably have figured a lot of this stuff out on your own. And there's probably it's real. I see a lot of entrepreneurs come into things thinking that anything they don't know about isn't important. And so I would encourage you to do a shift in the way you think about stuff like this. The estate planning is really important. It's not something you buy off the shelf and walk away from. It's something that is it's an ongoing process. It's an ongoing conversation. It's an ongoing engagement. Families with generational wealth know this. And you're gonna be a family with generational wealth. So this is a headspace shift to start taking this really seriously and giving it your attention, which I know can be hard to do for entrepreneurs. You're used to, your ability to focus on the thing that you feel like is the most important is one of the ways that is a key for success for you. But being able to keep this running in the background is something that remains important and isn't just an irritant that you feel like you have to get out of the way, but it's something that is an ongoing, like you nurture this. That is a critical headspace shift that I would just implore you to figure out.
Yep. Yeah, because everything changes. I mean, like we're saying, I mean, like tax laws might change next year. And so planning people did 5 years ago might not be the best planning a year from now. And so, we're looking at stuff 20, 30 years old that makes no sense today. So that's a good mindset. That's a good point, is to keep it, put it maybe on the back burner while you're building your business, but make sure it's still there and that you have the reminder to update it and keep it current. So.
Yeah, certainly. I think just keeping it on your to-do list and in your rearview mirror all the time is really important, because so often, even for non-entrepreneurs, people don't update their estate planning documents, and it would be better if they didn't even have them. So with that said, are there any other questions? Did anything come up in anyone's mind that's on the call that they want to ask Conrad and Brian before we go?
I had just a quick question, if you don't mind. So
Sure.
there are a lot of entrepreneurs who start the companies. So some of the employees also who are not co-founders, but they have huge stock options. So how do you help them, also when they are looking at tax planning and trust formation. And suppose they are working in a company which goes public, what happens then, and they have huge windfall in terms of money coming in.
So you're saying like their vested options in,
Yeah.
being an employee.
And then, some of these employees want to start their own companies. You gave a very good example of Microsoft. So, how do you help them to go about doing the planning, when they get a windfall, and then, they have to also look at starting their own companies?
I would say there's not one answer to that. It's always going to depend on can we help people like that? Absolutely. Is there a one size fits all for once you get into more nebulous areas like, okay, you've got vested options. What can we do with it? Well, it depends on what the terms of, it depends on what the terms are. It depends on, that's a question. What can we do with that? And getting hooked up with an estate planning attorney or a team that can analyze what you've got and give you good answers. That's what you can do is get people who can look at it and figure it out. It's a puzzle.
Yeah, I agree with Conrad. There's not a one size fits all. And I think kind of an important takeaway is there are lots of different techniques and lots of different opportunities. And maybe the most important takeaway is if you have somebody that is starting a business, they started a business and it's increasing in value, they have options, they may have options, have a discussion. Just start a dialogue with somebody. Because every situation, because what that person wants to have happen is going to be different than the person that's sitting next to them. Is it income tax? Is it estate tax? What are we concerned about? What do we have? When's it going to vest? So, Conrad and I threw a lot of different strategies and techniques out there. I guess maybe a really important takeaway is just make sure they're having the discussion, because it's easier to have the discussion early and to plan early than it is when they're worth a lot of money later.
Thanks, Brian. Conrad, can I get in touch with you, through LinkedIn
Sure.
or something like that? Great. Thank you.
Leah, do you have all the attendees? Can you send? You're muted.
I do, yeah. And before we go any further, I should also ask for Brian and Conrad if you could just let us know your contact information so everyone who's on the call can write it down. If you just tell them your emails and your phone numbers, that would be really, really helpful. So maybe put it in the chat. That way they can copy it, just so they have it. But I'll send you obviously the list after. Any other questions? All right, well, I guess there's no other questions, which is good. It seems like you guys really covered a lot of ground, and I think everyone really appreciated it. Do you mind just, I guess, giving one sort of closing remark or tip that you want people to really just take away quickly before we go?
To steal from the really cheesy Chicago election, plan early, plan often. Plan early. It's easier to plan with money you don't have. And then, as Conrad said, plan often. Review it, make sure you take a look at it, make sure it's up to date, make sure everything does what it is you want it to do. I might steal that from myself, actually.
Great. Well, thank you everyone who's out there, and really appreciate your time, Brian and Conrad. This was great, and I think really educational for a lot of entrepreneurs.